Welcome to Once Upon a Coin, documenting the ongoing history of blockchain and cryptocurrency. And as always, I'm your storyteller, Jason Cassidy. Today's story has us continuing our journey through each year of crypto, and this stop has us looking at the fallout from the great bull market of 2017. The world had just been put on notice that crypto was most definitely the real deal, with billions of dollars pouring into the industry like never before, forcing governments and big corporations to start paying serious attention. But there was still a lot of unresolved business to be settled from issues that had been brewing for a very long time now, and this was the year that a lot of that was being dealt with. Some of these issues were just too big and too contentious to resolve though, creating some of the most incredible moments in blockchain history. So strap yourself in, because we're about to take an up-close and personal look at exactly what happened. This is the story of crypto in 2018.
Sun cast a shadow, a digital line is coming over the mountain and over your mind. Double down your Bitcoin, hang on for the ride. We're moving into the future, one block at a time. One block at a time.
For starters, let's briefly review what happened in 2017, because that was like being on a spaceship that went straight to the moon and back. Bitcoin had gone on an absolute tear in the second half, almost hitting $20,000 per coin in December before coming back down to earth. As the calendar flipped over to 2018, January ushered in a steep decline, seeing Bitcoin fall all the way down to the $10,000 mark per coin before month's end. But the price could move a lot faster in either direction than institutions or the public could react to, and thus a lot of good news around cryptocurrencies being accepted started trickling in to start the year. First up was the Swiss municipality of Chiasso, who announced they would be accepting Bitcoin as a legal form of tax payment. This was done after the mayor had met up with some crypto experts and really liked what he heard. There was also a belief that they could compete with Zug, which is another city in Switzerland that had already gained the reputation of Crypto Valley. Chiasso had recently lured many crypto startups to operate within its region, so this was a nice way of welcoming entrepreneurs and companies to relocate there. By January 10th, Ethereum, which was going through its own bull market run just like Bitcoin was in 2017, peaked, coming in around $1,350 per Ether before dropping back down. This was a real shocker to a lot of people who weren't convinced that another coin or token could ever come close to challenging Bitcoin's supremacy. And while Ethereum had a lot of work to do if it ever wanted to be seen as a legitimate contender to Bitcoin's throne, smashing through the psychological $1,000 barrier with ease was a good first step towards that goal. January also marked a milestone for Bitcoin, as 80% of all coins had now been mined into existence via the protocol. There just wasn't a lot of Bitcoin left to go around relative to the number of people on the planet, which is about 8 billion of us. The start of the year also saw a wave of censorship kick in, something that was not well received by the blockchain faithful. Facebook kicked off what would become a series of mainstream attacks against crypto when they announced they would be banning all ads on their platform that were cryptocurrency focused. You see, a lot of money had been made and lost in the ICO boom that had taken place in the previous bull market that was just winding down. Facebook used this as a rationale for restricting any advertising of the industry to their user base. Meanwhile, the only coin that had seemingly nothing to do with an ICO kept honoring gravity, as Bitcoin plummeted once again, this time falling down into the $8,000 range in February. By March, it was time for Google to pile on top, as they too announced via a company blog update that they were going to be outright banning all crypto-related advertising. This all took place on March 14th, with the ban going into effect in June. This was beginning to feel like a coordinated act of suppression on crypto. Well, at least Twitter, better known to cryptonauts as Crypto Twitter due to its overwhelming influence on the blockchain space, was still a free and open platform to discuss all things cryptocurrency. Right, but this was well before the Elon Musk era of Twitter ownership, so you can probably guess what happened next. This banning of all things crypto was once again proclaimed to be in response to the unrestrained ICO, or initial coin offering madness, that had taken place in the previous year. The hope was that if the public wasn't having ICOs or new coins being advertised to them, then they couldn't get into financial trouble by investing into them. And to be fair, a lot of scam ICO offerings were launched in 2017. Having been in the thick of the industry during this time, I can personally attest to the number of bad faith offerings and the sheer amount of capital that clueless investors poured into them. Yes, a lot of people made money during the ICO boom, but even more people lost money. And this crackdown was a result of that, or at least that's what we were being told. And just how effective was the censorship in trying to turn investors away from ICOs? Well, you tell me, because in the first 3 months of 2018, ICOs raised a whopping $6.3 billion US, which was more than the total raised from ICOs during the entire year of 2017. Suffice to say, while the ICO boom would slow down considerably during 2018 as the bull market ran out of steam and ceded control to a bear market, at least to start off the year, it still had some gas left in the tank. The censoring of crypto to the masses would end up working, but it just needed a bit of time to take effect. Before the end of the first quarter of 2018, the G20 summit in Buenos Aires took place. And top of the list of things to discuss? Crypto regulations. You can start to see how coordinated an effort it was across the world during this time for big governments and mega corporations to come together and try to cool off the crypto industry. But while many big companies were shunning crypto, others decided to embrace it. On April 13th, Yahoo, one of the unicorns to come out of the dot-com bubble from decades prior, made headlines. This came in the form of Yahoo Japan announcing that they had invested into a top Japanese crypto exchange called BitArg. Yahoo, through one of its subsidiaries, took a 40% stake in the exchange, and in doing so made a big statement that at least over at Yahoo headquarters, they felt that crypto was still a pretty big deal. By May, the price of Bitcoin had fallen down into the $7,000 range, signaling to many that indeed, at least for now, the good times were likely over. It wasn't all bad news though, because Consensus 2018, the flagship conference for CoinDesk, kicked off. The 3-day event, which ran from May 14th to the 16th, served as one of the largest crypto-focused gatherings on the planet. New York City played host to the occasion, which had a ticket price of $2,000 and brought in over 8,500 attendees. While the average Joe may have now been turned off to crypto due to the cold water being applied by governments and corporations, hardcore cryptonauts were clearly still interested, and Consensus proved it. As the summer approached, another major player in the regulatory enforcement arena, the SEC or Security and Exchange Commission, made a ruling on both Bitcoin and Ethereum. With all these attempts to extinguish the crypto flames to start the year, many people were expecting the worst and holding their breath. Well, what they got shocked them. The SEC ruled that both Bitcoin and Ethereum were not securities. This was considered very good news, as it meant they could not be lumped in with the list of growing projects that the SEC was gunning for due to them being labeled as an unregistered security. The basis of the ruling from the SEC was that the name didn't play a factor here, but what did play a factor was how the asset was sold, promised, and how it behaved. Based upon this criteria, Bitcoin and Ether were cryptocurrencies, while most other blockchain assets were tokens, and tokens were securities. On July 2nd, more good news appeared when Coinbase announced the opening of its institutional custodial service dubbed Coinbase Custody. The service aimed to attract hedge funds, exchanges, and even ICO teams that were running legitimate token sales with a legitimate product to back it. If you can believe it, even more good news came from the institutional side of crypto when the parent company of the New York Stock Exchange, Intercontinental Exchange, announced the launch of Bakkt, a platform for digital assets that would include Bitcoin futures. So far, 2018 had some major players legitimizing the blockchain and crypto industry by virtue of their inclusion in it, and doing so on a grand scale. But you wouldn't know that by simply taking a look at the prices though. Ethereum, which had ripped to a high of almost $1,400 per Ether to start off the year, was now engaged in a rather ugly free fall, landing in the $200 range for part of the month. On August 22nd, the SEC denied another round of applicants that were looking to launch a Bitcoin ETF, or exchange-traded fund. And just like the Winklevoss twins that had tried and failed in the past, the rationale for this denial was that the markets were still too rife with fraud and manipulation to justify allowing such an investment vehicle to come out. The Lord giveth, and the Lord taketh away. October brought more good news, and once again, it came from the very top of the finance sector. Fidelity announced the launch of Fidelity Digital Assets, which would offer custodial, trading, and advisory services on cryptocurrencies to institutional investors. The message was clear and loud now. Wall Street, Silicon Valley, and just about anywhere else that money and tech were gathering was now taking crypto very seriously. October also brought the long-awaited and well-received 10th anniversary of the Bitcoin white paper. At the end of the month, on October 31st, many celebrated Bitcoin's first decade of existence, allowing them to reflect on all the growth that had taken place in the industry during that time. If you actually stop to consider all that transpired in the first 10 years after Satoshi Nakamoto introduced the world to Bitcoin, it really is humbling. November saw a major event unfold, and it was firmly centered around the ongoing Bitcoin drama. Bitcoin BTC had undergone a contentious hard fork the year prior, which resulted in the creation of Bitcoin Cash. Now, a year later, more trouble was brewing, but this time it wasn't centered around Bitcoin BTC itself. It was actually an internal battle that was taking place within Bitcoin Cash. What comes next is full of complexity and serious intrigue, so it probably deserves its own episode. For now though, the short version is that once again, one camp wanted to have smaller blocks and keep the block size limit at 32 megabytes, and this camp was represented by Roger Ver. The other camp wanted to increase the block size limit to 132 megabytes, and this camp was represented by Kelvin Ayre and Craig Stephen Wright. When both sides came to a stalemate, once again, the only resolution left on the table was a hard fork of the Bitcoin Cash blockchain. The new version of Bitcoin that was created as a result of the fork was called Bitcoin SV, with the SV standing for Satoshi's Vision. This name was rather fitting for Bitcoin SV given that the main technical mind behind the blockchain was Craig Wright, who was also the man claiming to be Satoshi Nakamoto, the inventor of Bitcoin. All this chaos took place on November 15th, 2018. I remember this time period well as I was having dinner with some friends here at a restaurant in Antigua, and Kelvin ended up sitting across the way from us. So you can probably take a guess at what the conversations were revolving around that evening. This all took its toll on the Bitcoin brand, given that the currency was already in decline. So all parties involved suffered from the dilution of the name. Forking is very much a technical term, and the reasons behind the fork here were as much technically based as they were politically motivated. This created a lot of confusion and anxiety within the industry, let alone for curious onlookers. People were trying to make sense of this heated debate that was now spilling over into a third contender for the Bitcoin title in Bitcoin SV. By mid-December, Bitcoin was now suffering badly, having dropped down into the 3,000 US range. Ethereum wasn't faring much better, with a single Ether trading below $100 US. It was a bit of a mixed bag in 2018. From a price perspective, it was clear that the air was now let out of the balloon and the market was rapidly deflating. And yet, from a growth perspective for businesses, especially at the institutional level, there may have never been a more prosperous year in crypto history. All of these investments being made would eventually go on to yield some incredible innovations and improvements across the entire blockchain sector. But the world would have to wait a little bit longer to see the fruits of those labors take shape. Because before that could happen, some truly incredible events had to first take place within the industry. Things that had never been seen before and that most people thought was simply impossible to achieve. And that's basically what 2019 was about. The unthinkable taking place. Some for the better, and some for the worse. And that's exactly what we're going to be looking at in the next episode within our series. So be sure to check out the story of crypto in 2019. I hope you enjoyed today's stroll down memory lane. Until next time, have fun and enjoy life, my friends. I'll be back soon with another incredible story to tell you.